Imagine this. You have just received a liquid cash amount of over $1 million. Perhaps it is from a successful business withdrawal, the sale of property, or an inheritance. It is still in your bank account. You know that leaving it in cash is a certain loss due to inflation. But when you turn on the news, you hear that global markets are volatile or that indices are reaching all-time highs. So, you are facing the ultimate investor's dilemma. Do you take a deep breath and invest all that money in the market tomorrow? Or do you play it safe, divide it, and gradually put it into the market over the next 12 to 24 months? If you are losing sleep over this decision, you are not alone. Hello, I am Kunal. For over 20 years, I have worked as an investment and asset management specialist, navigating the Indian and global markets. At EPK Capital, we build wealth for generations. Today, we are going to resolve the great debate, DCA versus lump sum. We are going to look at what the historical data actually says and highlight the biggest mistakes made by high net worth investors. We will have to face the elephant in the room before comparing strategies, what I call the waiting game. When you have a liquidity of $1 million or more, the fear of making a mistake paralyzes you. You wait for a pullback. But when you are waiting, your cash is affected by cash drag. Think of your cash like a piece of ice sitting in the warm sunlight. Every day, inflation reduces your purchasing power. The goal is not to time the market. The goal is to maximize your time in the market. Lump sum investment means investing your entire capital at once in a diversified portfolio. Dollar cost averaging, or DCA, is the process where you invest the same amount on a fixed schedule, let's say over 10 months. It looks attractive. It feels safe, like dipping your feet in a pool. But what does the real data say? If we remove emotions, there is a clear winner. The Vanguard study looked at nearly a century of market history. Their conclusion: a lump sum investment outperforms dollar cost averaging about 68% of the time. Almost 7 out of 10 times. There is a structural upward bias in the stock markets. Historically, the market goes up in 3 out of every 4 years. With DCA, you are holding cash while the market generally goes up. You are just forcing yourself to buy at higher prices. So why do I allow DCA? Because it's about investment psychology. Short-term pain can be extremely distressing. It is the feeling of avoiding loss. We feel the pain of losing money with as much intensity as the joy we experience in earning money. This leads to the second biggest mistake, panic selling. A correct strategy is useless if you abandon it during turmoil. DCA works like an emotional shock absorber. If the market falls, you feel relieved because your next purchase becomes cheaper. If your time horizon is long, cash is actually surplus, and you have the discipline to ignore the news, then choose a lump sum. If money is the life-changing percentage of your wealth, or if fear is preventing you from investing, then choose DCA. But if you choose DCA, keep the window tight. Compress your schedule. Distribute capital over 3 to 6 months. An imperfect action is better than complete inaction. The best time to plant a tree was 20 years ago. The second best time is today. At EPK Capital, we build wealth for generations. Let's prepare your strategy today. Thank you for watching.